The next stock we're going to do, Paul, is Diageo, DEO. Paul, go ahead.
All right, $95 billion market cap.
Good Lord.
This PE ratio, 62. That's a slight X.
Yeah, boy.
They do hit the profit margin, though. It is over 10%. And they pay a 2.3% dividend. On $94 billion, that's about 1.9, call it $2 billion here.
Okay.
$2 billion dividend, okay? So we have one X
And one
on
check.
this nosebleed PE, and then a check mark on the profit margin, and a $2 billion dividend that we have to go to the free cash flow and see if it's going to work.
Revenue growth is pillar number 3. Paul, what about the revenue, baby?
Let's see. Do people like their alcohol? Looks like they do not.
Uh-oh.
15.55 down to 14.8. I will say this. This includes COVID. So it was increasing. So I will say, even though this is an X, guys, you got to look at the data in between. Their year ended in June of 2020. That was the middle of COVID. They'd already absorbed like 4 months of COVID. So they were growing, collapse. So it is still an X, but this is why we do the 8 pillars and we aren't rigid about it.
Pillar number 4 is profit growth, Paul. How's the profit going?
Another X.
Probably down last year.
Another X. 3.3, 3.3, 4, 4, 1.8.
Boy.
So again, it's an X, but let's keep in mind, COVID X.
Shares outstanding is pillar number 5. We want this going down as well.
It is down, baby. Check mark. 627 to 586.
Nice. Current assets over current liabilities is pillar number 6.
Current assets of $16 billion.
Okay.
Current liabilities of $9 billion. Chickadee check.
Great. Free cash flow growth is where the rubber hits the road here, Paul, with the free cash flow over the past 5 years.
Okay. $3 billion, 2.1 billion.
Uh-oh.
No.
So X there. And then we have 3.3, 3.4, 3.4.
Divided by 5, the free cash flow is 3. Call it 3.
Now remember, again, free cash flow drop because of COVID. We're going to call it 3. I'm willing to go 20 times. As developing markets get, like to me, they have a lot of really good brands. And as the rest of the world and the emerging markets get wealthier and wealthier, nicer brands are going to do better and better. So from a long-term perspective, am I willing to bet on somebody that has and by the way, I think they own a piece of Louis Vuitton or something in there, it said. So am I willing to pay $60 billion for this company? I think I am.
The current market cap is $95 billion.
So it needs to fall quite a bit. It is an X on that one as well. But there's a lot of X's here that are COVID-driven, guys. So this is what I love about us doing this. It shows that there is something to be looked at. You have to look at things as a story. That's what 8 pillars are telling us. The story is telling us that during COVID, they took hits. Understandable. People couldn't go out to restaurants. They couldn't go to bars. They couldn't do any of these things. That is understandable. Let's see how their free cash flow was in the last 12 months with a rebound. Let's see if it got better. Oh my God, it got way better. It went to 3 points. It's actually higher than it was as their average. So I'm going to look at this one and I'm going to keep my eye on it and buy it when the price has dropped. Let's add this one to our watch list here. Let me look at the options here.
Before you leave that page, Paul, what is the target price? You know, it's currently at 160. What would you like to pay for this company?
100.
Okay.
So
Options?
DEO. Let's go out.
Do you want to head over to Mo for momentum before you get to options?
Yeah, let's do that.
Mo,
Yeah.
what do you got over here?
So this is interesting. I'm not really sure what it means, but it's interesting. So if you look, we have the stock consolidates a lot. So consolidation means that it kind of sits in a range and just bounces up and down between that range, and then it drops, and then it consolidates, and then it rises, and then it consolidates again. And here you had this big jump up. So it seems like this stock is very affected by announcements or earnings or something to that effect. And even when you do have these big jumps, you see you were in an uptrend right here, and all of a sudden this happened, the stock fell, and you turned right into a downtrend. Where was the other one? Right here. Here was this gap down. You were going up, and all of a sudden, boom, it dropped down on you. So right now, it's turning into an uptrend, and I want to say that's great, but I'm also saying, okay, I kind of want to see when their earnings date is, because I'm expecting, based on history, because we're consolidating right here, we could drop down here in some range. So I'm staying away from this one. I don't want to have, just based on history, like I said, a chart is a story, and you kind of get a feel of every chart that you go through, and this is a perfect example of getting a feel of something and seeing things and recognizing them and being willing to take that risk or not.
So if I want to buy this thing at 100, and I'm going to go 198 days out to August 20th, 2021, I'm going to get roughly 60 cents for that. That is 0.6% divided by 198 days. So you're roughly going to get 1% annualized return, give or take. You're not going to get much return. There's probably not a lot of volatility in the stock, so you're making about 1% of your money. It's better than zero, but I wouldn't be doing that. I'd wait for the volatility. I'd wait for hopefully the stock to fall. And then when stocks fall fast or go up fast, volatility is huge, and it affects the pricing of options. And if you're a seller, you can make more money that way.